Hey, welcome back to STRonomics. I'm Bill Faeth, founder of Build Short Terminal Wealth. I'm joined by my friend Kenny Bedwell, founder of STR Insights. Kenny, ADRs are dropping. They have been since pretty much probably summer of 2022. We're getting ready to head into summer. Now what? What do I do?
You're screwed. No, I'm just kidding.
Sell, get out, sell, Mortimer, sell.
Sell. Turn them into MTRs and LTRs, right?
Okay, yeah, go back and listen to the last episode if you want to do that.
That's an inside joke. If you want to be a part of it, go watch the other
Is that like a
episode.
Logan, Ohio joke or a Blue Ridge joke? Kenny
Yeah, there
hates,
we
just
go.
FYI, you don't even need to listen. Kenny hates MTRs like he hates Logan,
I
Ohio
don't
and
hate
Blue Ridge.
MTRs. Yeah, there we go. Now I'm gonna start getting messages from all these people like, why do you hate MTRs? Why are you the way that you are? So ADRs are falling across most markets. ADRs are falling. Now, here's a really interesting thing. Some properties ADRs are increasing because of the quality, the style of the property, the uniqueness of it, yada yada yada. Like because demand technically is still going up. Okay, more and more people each year use Airbnb, contrary to popular demand or belief. Okay, in the news, what you hear, people still use Airbnb, and more people are using Airbnb.
Well, it's all because of the icons update. I mean, if Brian wouldn't have like bought the up house, we would be in trouble.
Yeah. Oh goodness. Still done with that. Feel like that guy just wakes up and is like, "We're gonna do this today," or like, "Oh
Actually,
boy."
I'll take 20 seconds and I'm going to do a shameless plug for my STR Unfiltered podcast. I had Will Slickers on and he completely changed my perspective on that update. He's had behind the scenes access to Brian Chesky for like the last 100 plus days. And the long-term plan, I get it now from a marketing perspective and what they're doing to try to bring more people into the app. Does it benefit us as hosts immediately and that type of stuff? No. Do they love us? No. Are they guests first? Yes. All that type of stuff that frustrates us as hosts, but I do understand what they're doing with that. And I think it's going to benefit all of us long term.
Cool. Until it doesn't.
Right. There you go.
Until it doesn't.
Yep.
Anyway, so yes, ADRs, but overall ADRs are falling. And I've noticed that with a lot of my properties too. Here's the thing though, to calculate revenue, there's two pieces to it. It's not just about your average daily rate. It's about the occupancy rate and your average daily rate. So what I've been able to do is competitively adjust my pricing. Okay. So my ADRs have dropped, but my occupancy rates have gone up for most of my markets because demand is still there. Okay. It's just gotten a lot more competitive and people are just a little more price sensitive, especially with things being more expensive. And so if I can attract more people or create other ways to monetize what people are there to stay, and there's a couple ways to do that we could talk about, I'm actually making more money year over year. And especially my Watkins Glen property, my summer months, I mean, they're still really, really good. I'm not going to lie. Like I'm doing well, but I did notice the ADR overall is just a little bit less than it was last year, but my occupancy for the year has gone up and I'm going to make even more money than I did the year before, which is insane. So yeah, and then my return on equity is going to be really low. So I'm going to have to sell it soon. But anyway, but I've noticed that and I've had to adjust and pivot, especially this past winter. It was extremely competitive in Buffalo. And I had to make some changes because I was losing money. And I'd never lost money on some of my Buffalo properties before. And they're established. One of them has 348 reviews, which is insane. So I had to get competitive with my pricing. I had to institute more pricing strategies and also increase. Went in, did a refresh, added a few amenities, took some more pictures, increased, made the business better, made it look better. And boom, I started getting more bookings, increased my occupancy rate. And then when I found out though, is I tried to increase my pricing again because okay, I'm doing better, but then it slowed off. And so I noticed that if I lowered it to a certain amount, I could get the occupancy at a sweet spot. And that's, I think, what it's all about, is finding that sweet spot as the market shift. What say you, Bill?
Yeah. I would say that my good properties, I've done the exact same thing. I have 3 properties that are mega super properties, like way above everybody else, and kind of a similar approach, but I've actually raised my ADRs. Dragonfly, as an example, my number 1 property. And the big thing for me is instead of being 7 nights, Saturday to Saturday, which I was for super long term, like 200 days plus out for bookings, and I got about 50 to 60% of the summer booked on the Saturday to Saturday, which I run from Memorial Day through Labor Day. But then I've implemented the 3-2-1 and I went down to 3-night bookings, which I've never done in that market before. But I increased my ADR by 27% on the 3 nights, 35% on the 2 nights, and 55% on the 1 nights. And what I've seen is the average booking now. So I do have like a Saturday open and a Sunday open, like even in July. But because of that rate increase, it's offset that and it's actually more profitable. So even though during the super peak time, Memorial Day to Labor Day at the beach, my occupancy is probably going to be down slightly. I'll probably end up being around 92, 93%, Kenny, because I'll probably have about a couple of days each month that are going to be open. But the revenue looks like it's going to be up about 13% over last year in that time period. Now, going back to what you said about your properties, like in Buffalo and that type of stuff, and the shoulder season and the off season, that same property, my Dragonfly property, I did 341 or 342 last year at that property with zero revenue in January and February. Zero, because I don't do, I wasn't discounting my rates, right? I was like 300% higher than the medium. And I changed the strategy this January and February. And I was literally right around the medium and I did occupancy at like 65% in both of those months. And I was probably about 10 to 15% above on the weekends because it's a super high demand property, right? But I was like 10 to 15% below the median for a 6-4, during the week. And then I would discount that down. I had one, so 4th of July is 37.50 a night. So that's my highest rate I'll get outside of a compression event. In the middle of COVID, I got $5,000 a night for Hangout Fest for 4 nights, right? So 37.50 a night. I actually let that property go for like 298 a night for Sunday through Wednesdays in January and February. And that's where I went from 0% occupancy to like, it was either 67 or 67, 66 or 67% in those months. So I've gone through and I've done some analysis on what I need to be looking at from an occupancy standpoint. I need to be at 91% plus Memorial Day through Labor Day. Outside of that, where I used to shoot for like 55%, when you heard me preach, raise your prices, rate every booking, raise your price by 10%. Well, now it's different. Now I'm looking in the 70th percentile. I'll even push to 72, 73% September through April, right? And that's what's happened. That's the only way, as much as it pains me from a mindset perspective, where we all do get attached to our properties, and this is my number one property, and I'm getting beachfront plus, revenue when I'm not beachfront. I have to do that if I want to still be sustainable and hit the same numbers or increase what I did last year. I don't think I'm going to increase what I did last year. It's going to be really close. So right now, and I track every month my what I call tracking that I learned from a guy in the car business years ago, to where I'm forecasting what I'm going to do for annual revenue. And right now I'm tracking 323, I think 326 when I checked it last week. Whereas I did like 342 last year. There's enough room there, or the delta is small enough to where if I still have about 9 days open in July, right? And I know I will book the 4th of July. I just lowered my rates and my minimums on that actually 2 days ago. It's going to book. I'm not worried about it, even though I'm way inside like that 118-day lead time in that market because of the demand of the property. Now I have another property in the exact same market that is not, it's a good property. It performs well, but it doesn't have that demand, right? And that is not even close to the same summer strategy. Now I'm really I went to the 3-2-1 like 100 days in advance, right? To start getting those booked. And instead of waiting till 7 or 10 days to try to do the upsell on those gap nights, I started doing it like 30 days in advance, right? To give me more options to be able to sell, then come back and even discount more. So it is taking more work, but it is way more of an occupancy game now than it is an ADR game. So overall, my portfolio, I went back and I looked in 2021, I was at like 53.5% portfolio wide as occupancy. Year to date this year, I'm at like 69%. That is a huge delta across 13 properties. Those are just my own properties, doesn't count co-hosted in that delta increase, right? But I'm also 3.5% above revenue from 2023 and 2024. And if I didn't play the occupancy game, there's no chance I would be there.
Yeah. And I mean, it sounds like too what you just said is you're improving occupancy during the shoulder and off season, correct?
Yes, and I'm taking advantage of the 3 super high demand properties that I have, only 3 out of 13. The other ones are good, they're super properties, blah, 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 but these are the only ones that are super duper high demand. And I'm increasing rates, but the only way I can do that is by lowering minimums.
Yeah, that's interesting. Yeah, so you're pulling the multiple levers to adjust, and saying change my minimums but increase rates.
So we have dynamic pricing in our industry, right? But you know what this is from a data standpoint. It is price elasticity, which is different than dynamic pricing, right? So I've had to test how much can I stretch that pricing up by lowering the minimums, right? And I started at 7 days, Saturday to Saturday. Then I dropped it to 5. Then I went to 4. Then I went to 3. And I incrementally raised the price every single time. And just like you talked about previously, I'm tracking it and I'm documenting it so I can figure out and remember what that sweet spot is, right? And for me, it's really that 3-2-1 pricing strategy on these bigger properties to where I'm able to go and increase that rate by, I think it's 27, 35, and 55%, based on the minimum nights. And I will sell, those one nights. There's no, well, I'll probably have some gaps, but I'll probably sell a good 50 to 60% of them. And you're talking about taking like a $2,500 a night property and adding $1,250 onto it and then discounting it, significantly, like 50, 60%, so I can still get 17, 1800, but give the guest a nice $600, $700 discount to where they feel like they're getting a deal. This is all the psychology. That's all it is of how you do price elasticity.
Yeah, that's really interesting. And I just feel like a lot of people get caught up in this like whole ADR thing. Like, oh, what's the ADR? Like my ADR is dropping. Like, what do and how do I improve my ADR? And there's just so many other, as you mentioned, there's so many other levers that you can pull to increase your revenue. It's not about ADR, it's about your revenue, your gross revenue. That's why I've always kind of been baffled a little bit about why people like talk about ADR so much. Like I know it in the hotel industry, average nightly rate or ANR, and they're looking per unit and stuff like that. And that's how they're kind of like tracking occupancy and then their nightly rates for the rooms. But we're not renting by the room, we're renting single family homes. And so we really it should be kind of closer to looking at focusing on how do we increase revenue. And if you increase occupancy, that can increase revenue. Now we don't want to be 100% occupied, and drop our rates to like $1 or $100 a night. But we need to also like understand how to be aggressive and during the off season and the shoulder season. So like just this year alone for my Watkins Glen property, last year I had 0 bookings from January to April. Nothing, not a single booking. And I dropped my prices. I did everything could, just nothing. And I was like, well, it is what it is, and I kind of knew that was expected, but it was like painful to experience, like 0. And I'm like, and property still did really well, but I'm like, the next year, I'm like, what can I do to improve this? How can I do this? So I did some research and it's like, okay, I added a hot tub and I also added a theater room. Okay. So I made during the months of January, so worst months out of the year, this is a $350,000 property. I made $20,000 in that same period that the year before I did made $0. $20,000 more. Okay. So that obviously covered that crap that I just had almost, because I had to pay a little extra for the theater room, but like it pretty much covered a lot of the crap that I just put in just by adding those things for one season. Okay. And my occupancy jumped up. Even though my average daily rates are a little bit lower this year, overall, I'm probably going to make $20,000 to $40,000 more this year than I did the year before. And my average daily rate's less. So, riddle me that. So it's like, I'm focusing on doing different things, whether it's to increase occupancy. Like you said, you're focusing on your changing your minimum night stay requirements and then increasing your ADR off of that. It's all these different ways to pull besides dropping your prices to 0.
I'll tell you the biggest thing that I did, Kenny, is I have him next week. I've had Andrew Keller reshoot. He's doing not every property except for my Montana properties. everything. He's got one more to do. He's doing my lake house next week. And we've made updates. I showed you what Bria's doing in the new Banner Elk property. We're doing the same things, but I always had really good photos, but now I have what I consider the best photos. And sure, he's like almost 3 grand, to do a tremendous photo shoot. And I'm trying to convince him to do, video walkthroughs with an Osmo and stuff like that and drone because I have to send Chris to do that stuff. Right. But those are the investments to showcase. That's the marketing piece. So I've spent almost 35,000 bucks, I think, with Andrew in photos since October of last year, having him reshoot everything. And I want everybody to understand this. The photos I had were good. They were really good. They're not like your standard $300 photo shoot. I've been spending 1,000 to 1,500 bucks to find the best photographers. But now I believe Andrew is the best of the best. And I'm seeing that. I saw it immediately in Banner Elk when I had him reshoot, to where I was up 38% year over year. So didn't adjust anything, wasn't doing different pricing strategies. And the winter, it was a summer market. Now winter is going to be stronger than summer. And then, I had him do my new Banner Elk property. And then I had him go down to the beach and I had him do the OBX and all those things. And it's changing everything, with the best photos that you can get. I can't emphasize that enough. That's the only change that we made in Banner Elk. We actually switched out a set of bunk beds and switched it to a king. And that's it, outside of just having him reshoot photos. And we added string lights on the back of the house. That's it. So we're talking probably $1,500 investment for string lights and a new king size bed. And then the investment of Andrew coming, I think it was $2,750 for him to shoot that house. And I got that return probably in the first 2 weeks at least. So that there's a lot, like you said, there's a lot of levers. It's not just about the revenue management side. If you really paid attention to this, it's Kenny's talking about focusing on revenue, not ADR. I'm going to take you one step farther and factor in your profit into that as well. So one of the things that I've done is I just made a small change at a couple of properties. I went and I did the enemy method, like in Gulf Shores as an example, and I was charging $50 a day, for pool heating. And I saw that the average in the market's like 100. So I just went to 75. 75. We had 97 days of paid of pool heating. So that's literally another whatever $2,300 in profit, based off of that $25 increase in the pool heating fee for something that I don't know how everybody else does it. But when I turn it on, I just leave it on the entire winter anyways, because my occupancy is high enough to be able to support that. So that's a profit center. I made $4,200 net profit off of my pool heating based on the gas bill that I paid over that duration of time. That was a profit center, right? So there's a lot of these things that we can implement, like concierge services and stuff like that. You look at StayFi, has Arthur integrated with Viator to be able to sell tours and rafting and that type of stuff and get a commission. A lot of these little things we can do to increase revenue that isn't directly replicated or reflected inside of our ADR. It's not an ADR game. It's a profit and loss. It's a gross revenue and a profit game, right? That's really what you should be focusing on.
I love it.
Awesome. Thanks for joining us on this episode of STRonomics, folks. Make sure you smash that subscribe button. We'll see you guys next week. Happy hosting, everybody.